Well, hello. I'd like to welcome you all to the 15th Brand Finance Forum. It seems an awful long time ago since we began this whole process. And I'd really like to start by thanking the Banker magazine for its long and continued support for this initiative. I do remember that when we first started talking to to Brian Kaplan, the then editor, about this, he was really rather skeptical that bankers would actually be interested in brands. And James Park, who was then our communications executive, spent quite a long time convincing him that they would. Well, James is now strategy director at L&G, having gone to London Business School, so he's gone on to greater things. But he managed to convince Brian, and Brian cautiously put it into the February issue, thinking, well, that's a quiet month, so it won't matter if they don't like it. And I think we were all very pleasantly surprised, and particularly Brian, to find just how interested they were. And I'm pleased to say that that's continued ever since. Well, this year in December, Brian retired, and I'd just like to wish him the best good luck during retirement. And he's now handed over to Joy, who's with us today. So in 2007, when we first started this, we decided to run an event as well, which is the first of these brand finance banking forums. And it started really quite small at the Groucho Club. Now, this was in those innocent days before the great financial crisis. And I seem to remember that Andy Hornby, the CEO of Halifax Bank of Scotland, was there. We all had drinks, and there was probably more drinks than there was presentation. But that was a very small event of about 30 or 40 people. Now, since then, we've done them at the London Stock Exchange, the LSE, Cass Business School, the Savoy, RAC, and at City Livery Clubs. We've done them in Dubai, Singapore, Hong Kong, New York, and London. So it's really gone round and round in the last 15 years. And for quite a while, the BBC, I'm pleased to say, was sponsoring our dinner. And one of the high points of the last 15 years was when Vince Cable came along, who was then business secretary, and roundly lashed the banking industry. We had quite an interesting debate with various of the participants. We've also had a lot of CMOs and even CEOs of banks to come along, which just demonstrates how successful and interested they are in this subject. I have to say, from my point of view, it's been very stimulating. This is really the high point of our year. It's the biggest study and the first study that we really began doing, and it comes around every year and really is the high point of the work we do. We must never forget that the banking industry is actually the largest industry in the world as far as stock market capitalization is concerned, and it is an engine of growth. But over the years, very often people seem to forget about just how important the banking industry is. And I do remember back in 2009, at one of these events, we ran it at the British Bankers Association, and two separate film crews arrived because that was the year when Lloyd Blankfein was given 100 million salary. And I remember we were on various TV programs trying to explain why they had a brand and why it was a good brand and why he should get $100 million for it. But anyway, I don't know whether we succeeded, but Goldman Sachs goes from strength to strength. And in addition to that, since then, various developments have happened. One is that while we did have some very good data and some very good financial data back then, nowadays we have an extremely robust global research study which powers the results that we give. And Declan is going to be talking about that later. We've also moved on from just simply valuing the brands to measuring the reputation, and that's encapsulated in the research study that Declan will talk about. And more recently, over the last 3 years, we've launched a thing called the Brand Guardianship Index, which looks at the ability of CEOs to manage their brand and reputation. We launched that for Davos, and it's extremely interesting. A lot of the CEOs like looking at what's going on. And just to finish the sort of roundup of what's happened in the last 15 years, one of the standout moments was Stuart Gulliver decided to put the banker measures into the HSBC LTIP scheme. And so every year, we always used to get a lot of interest from Chris Clark of HSBC on behalf of Stuart Gulliver, finding out how they'd done, which was all very gratifying. And I'm sure they're still looking longingly at their results. Anyway, this year, given the nature of the strange year we've had, we decided to talk about COVID-19, whether it's a threat or an opportunity for bank brands. And you can look at it in either direction, and I'm sure we will in the debate. We've got Joy McKnight, the new editor of the Banker, Declan Ahern, our director of banking brand valuations, And I'm pleased to say we've got David Walden, who used to be our client at Vodafone, then went on to Barclays, and most recently was the group CMO of RBS. So he certainly has a lot to say about bank brands and how they work. And secondly, we've got Gareth Bullock, who is chairman of the Development Bank of Wales, but for many years was a director of Standard Chartered, working in Africa and elsewhere, and was very involved with their Here for Good campaign. So a very interesting Q&A in anticipation. And I'll now hand to Joy, and I look forward to all the presentations and the discussion afterwards. Thank you.
Great. Thanks so much, David. So obviously over the past 15 years, there's been a huge change in the makeup of the ranking, which is illustrated by this dynamic graph I'm just showing now of the top 10 banking brands year on year. So in 2007, Citi was the most powerful banking brand in the world, but then HSBC takes the lead until about 2011. In 2009, we saw the first appearance of Chinese brands in the top 10. 2013 to 2016, it was Wells Fargo that dominated the rankings. And in 2017, ICBC became the world's premier banking brand and has held that position ever since. So let's compare the top 10 banking brands in 2007 versus 2021. So as I said, 2007, it was dominated by Citi, but also in total by US and European brands. HSBC and Bank of America were also in the top spots. Interestingly, Citi had a higher brand value in 2007 than it does today. In 2021, it's all about the Chinese mega banks. It's the ICBC, China Construction Bank, Agricultural Bank of China, and Bank of China that top the ranking. And they've held these top 4 spots since 2019. ICBC is the world's most powerful brand for the 15th year running, or fifth year running, with a brand value of 73 billion. So both Bank of America and Citi are still in the top 10, as are Wells Fargo and Chase. HSBC, which was the largest brand in second largest brand in 2007, dropped down to 11th place in 2020. So there has been no European brands in the top 10 over the past 2 years. So over the past 15 years, we've really seen a shift to the east. In 2007, there were no Chinese brands in the top 100 ranking, as it was then. The American brands dominated and made up over 40% of the global value of the top 100. But today it's the Chinese brands that dominate at the top of the ranking and make up about 39% of the value of the top 100, whereas the US banks only make up about 24%. So between 2007 and 2021, brand value of the top 100 banking brands has doubled. During the past 15 years, there's only been 3 contractions of brand value in the history of the ranking. So once in 2009, just following the global financial crisis, when the banks were really seen to be at the root of the crisis. So a third of the top 100 brands value was wiped out in 2009. But then in 2020, we saw a small dip again of about 2%. And then in 2021, this year, again, there was a small dip of about 4%. But I think what's really clear is that the bank's brand value has held up much better than during the financial crisis, mainly due to the bank's role in helping clients deal with the impact of the pandemic. So for the past 6 years, I've written the Banker article that highlights the major trends found in each ranking. And in part of that, I get to interview the chief marketing officers and other brand champions at the banks, which gives me some insight into what's like top of mind for them. For example, I've had the pleasure of chatting with David Walden when he was at RBS a few years ago. So, and you'll hear from him directly in a little while. This year, the bank CMOs that I spoke to for the article really identified qualities like purpose and trust as key attributes for a strong banking brand, as well as delivering exceptional customer experience. They all emphasize the importance of supporting their customers, but also their staff through the pandemic as a way to generate a lot of goodwill around their brands. And the trust element is really important in the context of COVID crisis. As mentioned, regaining the trust that was really lost during the previous crisis. So delivering on customer needs is important under COVID, but also in terms of the digital transformation that the banks have been going under over the past few years. So those that have really invested in the digital capabilities were able to react quickly and innovate new products and services, which helped to maintain the brand value throughout the year. So I was thinking we could just do a little bit of a around the world tour of the banks that I spoke to, just to give the audience a little bit of a flavor of what they were talking about, starting with the world's most powerful banking brand, ICBC. So this year, ICBC has really concentrated its brand campaigns on the fight against the pandemic. The bank spokesperson talked about how it injected positive energy to society with speedy, powerful, and warm reports to demonstrate its mission and responsibility as a large bank. Over in the US, Bank of America became the US's premier banking brand this year, replacing Wells Fargo, which had held that crown for almost a decade. Talking to Meredith Verdone, who's CMO at Bank of America, she stressed the importance of staying connected to employees, to clients, and communities, as well as focusing the bank's efforts around digital and mobile capabilities. So such as like enhancing the virtual financial assistant, Erica, to understand Corona-related terms, questions, and requests. The 2021 ranking also had a new US premier brand that joined the ranking. Truist is the highest new entrance in the ranking, jumping in at 36th position, following the merger of BB&T and SunTrust at the end of 2019. So like rebranding following a merger is challenging at the best of times, but doing so successfully during a pandemic is pretty impressive. Venu Vijay, who's Truist's CMO, said that the bank is trying to create better ways to serve its clients and communities using the best of today's technology and marrying it with a deep belief in the power of human connections to reimagine its banking experiences. In Europe, we have Swedish challenger bank Klarna Bank, which received its full banking license from the Swedish authorities in 2017. It entered the top 500 ranking for the first time this year at 269th position. What I found interesting when I was chatting to Klarna CMO David Sandstrom, he made the point that the challenger bank doesn't really compare itself to other banks, but is instead focused on building a brand preferred by consumers regardless of industry. So he said that ultimately brands compete for the attention, headspace, and share of voice, and that spans across industries. Other brands to call out, one is Qatar National Bank, or QNB, which has spent a whole decade at the top of the Middle East ranking table and has moved up into the top 50 in the global ranking. According to Yusuf Ali Darwish, who's general manager of communications at QNB Group, QNB's brand shifted its promotional messages towards more awareness and cautionary approach to cope with the pandemic. The bank implemented a pandemic action plan, including a Stay Safe campaign, really designed to minimize contact and abide to social distancing rules. And it also provided premium banking benefits for Qatar's medical professionals in recognition of their work. It also enhanced QNB's educational tools and materials to promote the bank's digital e-channels and contactless payment solutions, and launched new products to serve its customers worldwide. And the last bank that I wanted to call out, even though I did speak to quite a few others, is the Commercial International Bank in Egypt. In 2021, it increased its brand value by 19%, the biggest rise among the top 10 African banks, and rejoined this exclusive club after a 3-year absence. Sharif Khalil, who's Chief Communications Officer at CIB, emphasized that the bank's success was down to its staff, which act as the brand ambassadors. As such, CIB went to the extra mile for its employees during the pandemic, including booking an entire floor in a 5-star hotel for the purpose of self-isolation. In addition, CIB ran several campaigns to help its customers shift to digital services. As Egypt remains a highly cash-based society, CIB needed to really make many of its services available digitally and help them make that transition. Therefore, the campaigns focused on its digital services and alternatives that the customers and non-customers could use to bank safely, such as CIB's e-wallet or mobile app, rather than putting themselves and staff at risk walking into the branch. So that's a bit of a whistle-stop tour around the globe, and I'll hand over to Declan Ahern from Brand Finance to dive deeper into the results.
Thank you, Joy. So before we dive into the topic at hand, I thought I would give everyone an idea of actually how we go about conducting the study in terms of the methodology to actually rate brands in terms of their strength and ultimately provide a brand valuation for each brand within the study. The methodology we use for all of the rankings we produce, at least in the public nature, is based on a hypothetical situation that the brand user does not actually own their brand in question, but instead must license it from the brand owner. Typically, that licensing is done in the form of royalty payments on revenues. And therefore, in most cases, because the brand user is actually the brand owner, they experience a relief from paying those royalties, hence the name, the royalty relief methodology. The first step in the process is to determine the strength of the brand relative to other brands operating within the marketplace. And this is done using a weighted scorecard approach that we call the Brand Strength Index, which is largely informed by our global market research program, which I'll touch on a little bit later. Once a score is determined and expressed as a score out of 100, we then apply it to step 2, which is determining an appropriate royalty rate for the operating segment. So hypothetically, let's say that retail banking commands a range of 0 to 5%, and the brand in question is rated as 80 out of 100. You multiply those two numbers together to get a specific royalty rate for that brand of 4%. We then apply those royalty rates to forecasted revenue figures, which is supplied by the institutional brokerage estimate system, sourced on Bloomberg or Reuters. And we then discount that post-tax to the present value, which is what we call the brand value. Now, when we refer to brand value, we refer to the trademark and associated IP that is separable from the entity that can typically be bought and sold in an arm's length transaction. As David mentioned earlier, and I touched upon, our banking publication and all of our wider valuations are underpinned by our Global Brand Equity Monitor Tracker, which we've now run for the last 4 years. We survey both consumers and businesses in terms of their perceptions regarding banks operating in their market. And research from this tracker is used within the Brand Strength Index. So on the screen here, we have an example of the Brand Strength Index construct. And this is segmented into 3 broad categories. The first being brand investment. And this is largely grounded in products, place, promotion, and price. The idea here is that a high level of brand investment would translate to high levels of brand equity. Now, as mentioned, we assess brand equity amongst consumers and businesses using our research. But equally, we use various data partners to determine perceptions of the brand among other key stakeholders, such as staff and investors. A high level of brand equity should theoretically translate to strong brand performance. And here we assess more hard-nosed metrics in the banking industry, such as return on equity, return on capital, margins, and revenue generating ability. Where a bank operates in multiple countries, we create multiple brand strength indices per country and aggregate them weighted on revenue to provide a overall brand strength and brand valuation for each specific banking brand. Now, it's largely through the lens of the Brand Strength Index, and in particular some of the research metrics, particularly reputation, that we can understand the potential threat and opportunity that COVID presents to the banking industry. Firstly, I think it's important to set the scene for the industry pre the outbreak of the coronavirus. So what we have on screen here is the average tier 1 capital per banking brand operating in the 10 most capitalized countries as of 2009. The green columns represent the 2009 figure and the red column represents 2020. Tier 1 capital is a core measure of a bank's financial strength. So it's an extremely important KPI in the banking industry. And we can see that the majority of banking brands began 2020 far better equipped to handle the COVID crisis than they were during the peak of the global financial crisis. And we have regulation largely to thank for that. Additionally, as we can see on this graph, which shows the average profit per bank in 2009 versus 2020 for the same 10 countries as the previous slide, banks have made a strong recovery since the global financial crisis with regards to profit generating abilities. However, it's widely reported and I think generally known throughout the industry that banking brands have been operating in an increasingly competitive environment where competition from the likes of fintechs and challenger banks, persistently low interest rates, and increased regulation is placing significant pressures on the profitability of the industry as a whole. Now, with the onset of the pandemic, we have seen banking brands play a hugely significant role in supporting consumers and businesses in combating the impact of economic lockdowns as a result of the virus. Things like distributing government mandated funds, extending credit, reducing fees, providing loan payment holidays, and in general being considerate to their customers. However, this comes at a relatively significant cost to the industry, and we have already seen huge levels of credit provisions being raised across the world as banks worry about credit defaults from their customers. So what we have on this slide is average loan loss provisions for the same 10 countries, where the 2019 figure is in green and the 2020 figure is in the red column. And what we can see as of the end of the second quarter in 2020, the likes of the US, the UK, Canada, Germany, and Switzerland all raised provisions significantly higher than they had in 2019. And increased provisions means reduced profitability for all banking brands. Furthermore, forecasting potential economic recovery into the future becomes essentially a guessing game, and many in the industry feel that the lasting consequences of the pandemic on the global economy and therefore the banking industry are yet to be seen. However, despite this potential significant threat to brands in the banking industry, for the first time since Brand Finance launched our global equity monitor tracker, reputation amongst banking brands globally is increasing year on year. So looking at the same 10 countries once again, we can see each of them, with the exception of Canada, has experienced a significant increase in reputation scores year on year. So the 2019 reputation score from our study is represented in the blue column, and the 2020 reputation score is represented in the red column. And these figures come from the end of October 2020, so a significant proportion has happened throughout the year with regards to the pandemic, and therefore this research captures those changed consumer perceptions. In fact, out of the 29 countries surveyed in our research study, 27 of them actually experienced increases in brand reputation year on year. Now, in order to determine exactly why reputation has improved, we analyzed the attributes researched within our survey. And you can see these list of attributes on the left of the screen now. What we have done then is to use a statistical technique in order to group this range of image attributes into more manageable factors for interpretation, which we can then label accordingly. So all of these attributes on the left-hand side are grouped in to these new groupings in the middle of the screen. And what we can see is all of the image attributes in the green, things like being easy to deal with, having excellent websites and apps. These can all be combined into one label, which we have called meets the needs of the customer. The other groupings we have are only care about profits, which is a negative attribute, ethical practices, and innovation. Again, using statistical analysis, we have determined that each of these separate groups plays a role in determining the level of reputation for a banking brand. We can see that the grouping meets the needs of the customers, ethical practices, and innovation all drive reputation in a positive direction and to a very similar extent. Whereas being perceived as only caring about profits will reduce overall reputation for a banking brand. Having identified which factors drive reputation the most amongst banking brands, we can assess the individual performance of these attributes year on year within our research. And over the period of the pandemic, banks on average have improved their perceptions in the following metrics. So within that first grouping, meets needs of the customer, easier to deal with, excellent websites and apps, and great value for money have all improved year on year across the entire industry. The second factor, only caring about profits, where again, a reduction in those scores is a positive outcome for reputation. Each attribute has improved year on year, with a very significant improvement in overall trust for banking brands. Within ethical practices, caring about the community and transparency have improved. And within the last factor, overall innovation, specific questions around innovation and perceptions of banking innovation, as Joy alluded to earlier, have strengthened year on year. Now, it's not a stretch to believe that each of these metrics have improved as a direct result of the overall industry's response to the pandemic, whether their hand was forced or not. So now we know why reputation has improved. The next logical question is, why is it important? And I'll use this graph to illustrate. So on the x-axis, we have factor 1, meets the needs of the customer, which you will recall is one of the primary drivers of brand reputation from the previous slides. And on the y-axis, we have brand consideration. Consideration is an extremely important metric within the banking industry, and indeed within other industries where brands are relevant, and is closely linked to customer acquisition and revenue generation. Our own research and client work, as well as work by other agencies, have proven time and again the links between increased brand consideration and increased revenue generation. As you can see from this graph, there is a strong positive correlation with the perception of a bank's ability to meet the needs of their customer and overall brand consideration. And as an extension of that, there's a correlation between brand reputation and brand consideration. I've highlighted on this graph banks that score the highest throughout the study in terms of meeting the customer needs. So Sberbank of Russia, which is our study's strongest banking brand as measured by brand strength, Capitec of South Africa, Post Office Savings Bank of China, and Maybank of Malaysia all meet the needs of their customers and excel within the study. So to reiterate the point I made on the previous slide, this graph now shows brand consideration on the x-axis and brand usage on the y-axis. Again, we can see the very strong relationship between consideration for the brand and claimed usage. And again, I've highlighted the best performing brands within the study with the same names appearing: Sberbank, Post Office Savings Bank, Maybank, and DBS Bank of Singapore. So, well, anecdotally, it's great that reputation among banking brands is growing, albeit marginally. It is important to remember that there is a legitimate commercial interest for banking brands to take steps to ensure that both reputation and brand consideration are continually improving. And it's vital that brand owners invest particularly in meeting the needs of their customers, whether that is through innovation or through other channels, remains to be seen. But ultimately, that is a strong driver of brand consideration and therefore brand usage and market share. Now, I mentioned some of those brands highlighted in the previous two slides, who are some of the leaders across the entire study in terms of reputation and brand consideration. These brands are also among the strongest banking brands in our study as measured by the Brand Strength Index. On the left-hand side of the screen here, we have the top 10 strongest brands. And I thought I would leave you with some examples of how these brands have best served the needs of their customers throughout the pandemic. Sberbank, for example, which Joy has mentioned earlier, they've been at the forefront of digital innovation in Russia for a while, and have now in fact extended their offering to a lifestyle platform where customers can not only bank online, but access online cinema experiences, ride-hailing services, food delivery services, and a range of other products and services, as they literally attempt to meet the need of all of their customers and meet all of those needs. Capitec, like many banks worldwide, offered payment holidays to their clients during the height of the COVID pandemic in South Africa. However, they recently took it one step further and announced a cash refund on interest charged on those loan holidays for over 80,000 of their customers. DBS Bank announced a digital relief package immediately as the pandemic broke, which enabled their SME customers who owned retail stores to move the majority of their sales online and prevent the disruption of their businesses during lockdown periods. Now, this is a great example of how servicing the needs of the client can also serve in the interest of the bank itself. Another example is Maybank, who launched a digital loan approval process for SMEs based on an artificial intelligence algorithm, in which its decision to approve a loan was reached within 10 minutes of beginning the application. So in doing so, Maybank is addressing an often painful and long process of manually applying for a loan and then waiting painfully for the decision to be made. And to date, I believe 99% of all loan applications that have been processed by the bank were approved. I would just like to remind everyone to please feel free to use the Q&A service to drop any questions you have for any of the speakers throughout the presentation today. I know David will be moderating the panel discussion, and I'm sure he will take some of your questions through that Q&A facility. And for now, it is my great pleasure to introduce one of our guest speakers today, David Walden. David's career started at Saatchi & Saatchi as a graduate trainee, progressing through the agency world as a managing partner at WCRS and then MD of Lowe Howard Spenk in London. He subsequently worked for the Coca-Cola Company as Global Director and VP of Advertising, before returning agency side as the President of BBDO Europe, and then as the main Board Director and CEO of Tempus Partners. Following WPP's purchase of Tempus, David set up Team Vodafone for the group. In 2004, he joined Vodafone as Global Director of Brand and Marketing Communications, progressing to become Global Brand Director in 2005, and CEO of Vodafone Ireland Marketing in 2008, based in Dublin. Returning to London, David joined Barclays in 2012 as MD of Brand, Reputation and Citizenship. And his most recent role, as Joy mentioned earlier, was as CMO of RBS, a position he took up in July of 2015. David is also President of the WFA, Chairman of the EGGB, and a Fellow of the Marketing Society. Over to you, David.
Thank you, Declan. Good afternoon, everybody. And odd for me to think that this time last year, I was approaching the last 3 or 4 weeks of my full-time career at RBS, because my job was done in that I was part of the cleanup team of RBS. And when Joy and I first talked about the state of the RBS brand, it was not healthy. But what we did over time was, by using the purpose of serving customers well, profound in its simplicity, we improved the performance of the bank. We made it safe and secure, and indeed started paying dividends, and the bank had restored itself, so that when we transitioned from the CEO that I worked for, Ross McEwen into the new CEO. Alison Rose took the job and started it in October 2019, revealing the new purpose of the bank and the name change to the NatWest Group on February the 14th. That was work that I and my team had done. I led the purpose work on behalf of the Exco and the board. So what I really wanted to comment on was what I have observed since, because as people tell me, immaculate timing, I wasn't intending to step into the third chapter when COVID struck, but I did. And when I left NatWest, the purpose was we champion potential, helping people, families and businesses to thrive. A very clear strategy was set that was going to focus on 3 areas. First and foremost, enterprise. NatWest has been for quite a long while Britain's biggest business bank. So I wanted to really focus on helping businesses thrive and develop. Secondly, on creating a learning culture, financial education externally. NatWest was the first bank to introduce education, financial education in schools 27 years ago. NatWest Money Sense started, and they wanted to focus and build on that. And thirdly, of course, and significantly on climate. And actually another way of saying that is that was a plan that had people, planet and profit at its heart, and a very clear strategy, very well received on the 14th of February. And Alison set about bringing that to life. And then COVID struck, by which time I was out of the bank. I didn't even get to do farewells and leaving drinks because of all of this, but there'll be time for that in the future. So I have observed what the NatWest Group have done. First thing they did was this features one of the words I hate most in marketing, is they pivoted. So they pivoted to include, I have to read this, we champion potential in good times and in bad to help the people, families and businesses we serve to recover and rebuild and ultimately to thrive. And they then took a series of actions, and a big shout out to all of the frontline people who have continued to do a remarkable job through this difficult time, and to the leadership of the bank who've continued to use purpose to drive their activity. And actually, I think things like the 330,000 phone calls to vulnerable customers that were made to check in, see if they were okay, things like the funds to help business recover, many of those actions I know driven by the Bank of England, but really been brought to life through what NatWest has done to live its purpose, and actually great to see them deliver that. And actually now, of course, I don't have access to internal data. I must use the external data, but before I talk a little bit about external data, I commend that you look on the NatWest Group website and look back at their report of July 2020, the mid-year results, because it was a report entitled Our Purpose in Action, and some incredible examples of what they've done, and some great demonstration, to steal an old bank in line, that they've really become a listening bank that's reacting to incoming and doing things better. And you can see that in the available data. So big fan of the most important assets you have are the people that work for you, and therefore you must build a brand inside out. If you look on Glassdoor, you'll see that the best performing mainstream bank in this fine island is NatWest, and the most respected CEO is 94%, is Alison Rose. 94% of the people that work for the group commend her as a great leader, and 80% of the people who work there would recommend it elsewhere. Now that's all ahead of the mainstream. What's interesting in this data is if you then go to everybody's favorite digital bank, Monzo, it's not the favorite of the people who work there. Only 57% of the people who work at Monzo would recommend it, and their CEO scores slightly lower at 78. And I could go on, but you get that point. The available external data on how banks are doing, which I'm grateful to for publishing their data yesterday, so I could look at that. And actually what you'll see if you look at that is whilst NatWest hovers effectively at number 8, it's the best of the high street banks, and it's the most improved of the high street banks. I would posit that that's by no accident. If you then look at the other available data, the CMA scores, much beloved by the board I used to report into, who were always irritated about the gap between internal engagement improving and customer engagement. And frankly, I think they still will be, because the most recent CMA data was from last August, and NatWest had moved up to the heady heights of 12th equal. Only a couple of points off being 5th, it must be said, but 12th equal nevertheless. So fan of what gets measured gets done. I think there's a long way to go with data that supports the bank's approval, but I commend Brand Finance for their 15 years of doing this, and long may you continue, because it's great to know that even bankers now believe that brands matter. And with that, thank you very much. Time for Q&A shortly. And I think it's...
Thank you, David. I'm sure you'll have a range of questions, particularly regarding around brand purpose and the previous work you did at RBS. Now, I'd just like to introduce our second guest speaker, Gareth Bullock. Gareth has over 40 years of experience in the financial services industry. He retired in 2010 from the board of Standard Chartered PLC, where he was responsible for Africa, Middle East, Europe, and the Americas, as well as chairing risk and special assets management. Gareth has both wide functional and international experience, having been head of corporate banking in Hong Kong, CEO of Africa, Group Chief Information Officer, and head of strategy in his previous roles. He also has significant industrial and retail board experience, both in the UK and China. Gareth has held numerous board positions, including Tesco PLC, Spirac Sarco Engineering, Fleming Family and Partners, British Bankers Association, and Global Market Group. Gareth was also a trustee of the British Council from 2012 to 2018, and is currently the Senior Independent Director of Informa PLC. Over to you, Gareth.
Declan, thank you very much indeed, and good afternoon to everybody. Thank you for this opportunity. I'm just going to make some remarks, really in a personal capacity. Just to be clear, the Development Bank of Wales is owned by Welsh ministers and doesn't compete with private sector financial institutions, and is essentially a debt and equity investment company, as opposed to anything to do with conventional retail banking, of which it has no activity. These are sort of three provocations, if you like, to just sort of things for us to think about that I think will feature on the banking horizon in the next 12 to 18 months, and indeed may last for some time after that. I think the first one is dealing with higher indebtedness post-COVID. I think companies exiting the COVID crisis will certainly bear greater indebtedness than normal after a year of essentially incurring more costs than generating revenue. Their businesses will clearly take time to rebuild profits and cash flow, as the economy itself will take time to rebound. And thus, I think while there will be viable businesses, their ability to repay debt will be constrained. Now, banks will be expected by those businesses to accommodate some variation in repayment terms to reflect that severe change in circumstances. The question is, will the main banks be willing and able to adapt to the new normal and show the flexibility required? At the very least, those businesses will probably need some combination of term finance with longer maturities, possibly as long as 7 to 10 years, lower interest costs, of course, less stringent covenants, some repayment holidays with possible balloon and bullet repayment structures. Above all, a willingness from lenders to be flexible and responsive to the characteristics of those individual businesses. It won't be a one-size-fits-all situation. Now, what that will require from the major banks will be that flexibility and responsiveness that a centralized and, I think, strict policy or formula-driven approach often finds difficult to allow. Particularly micro to medium-sized enterprises dealing with smaller bank branches will need managers who can make their own decisions within a policy framework, and that allows precisely that kind of flexibility and responsiveness. Now, I'm finding that there's quite a lot of talk in finance circles of the need for government to step in to assure this happens. How precisely the machinery of such a solution would work is not yet clear, but the success of the CIBLS and the BBLS schemes show that government and the private sector can work creatively and constructively together. I would argue that work needs to start now. I think it is something that will need to be centrally managed. And I think with sufficient time and forethought, some kind of patient capital facility to relieve that big bulge of indebtedness and to manage it out over time is going to be essential. The second point, I think, is just close to the heart, I think, of what previous speakers have been saying about trust and reputation, particularly post-COVID. And BBLS, the bounce back loan scheme, was put in place very quickly during an intense period of the crisis. And banks have essentially lent against a government guarantee. It's seen as no risk for the banking industry. And in one sense, that is true, but there is some moral hazard lurking in the unraveling of the BBLS and CBILS schemes. Many commentators, and you will have read this, believe there's significant fraud in BBLS. And indeed, some egregious cases have already been found and publicised. Many businesses, in spite of the availability of that finance, will fail, and jobs and livelihoods will be lost. And I think any politician of whatever colour will find him or herself under scrutiny for failure on both these counts, fraud and bankruptcies. And as ever, the danger of the inevitable blame game will ensue. On both sides, I think governments and banks will expose the other's purported failings as they become antagonistic one to the other. Now, banks, they'll say, we're responsible for the KYC, know your customer, and onboarding customers. Government, of course, they'll say was responsible for the liberal structure of the financing in the first place. So I think, in post-crisis leisure, whatever that will be, will permit a myriad post-facto rationalizations that mid-crisis panic couldn't really foresee. I think both sides will be on the back foot. And of course, there are no decisive winners in such a row. Brands and reputations will take a knock. But governments and politicians change or move much more quickly than bank brands do. I think a positive response to the potential indebtedness crisis of my first point could be a good way to avoid the post-BBLS problem of this, my second point. The third thought or provocation I'd like to offer is to do with localism and sort of post-COVID local banking. An important theme emerging post-COVID is that of local services. Whilst we've all realized, I think, the attractiveness of online shopping, home delivery, I think daily internment has perhaps also made us appreciate much more our local communities and how they do or don't operate efficiently. There's a growing trend of regionalism and localism. And indeed, that was, I believe, starting well before the COVID crisis. And I think the closure over the last few years of many bank branches in small towns and large villages, the large number of market towns across the UK have no net bank branch, or maybe just one. Free-to-use ATMs are disappearing too. Many people, and not just those who live in truly rural depopulated areas, have to travel by car or public transport to do the most basic of banking services. So if you ally this with a segment of the population who are uncomfortable with or lack trust in digital banking channels, or more problematic, more fundamentally problematic, those who simply don't have the mobile signal or broadband provision that allows reliable service, this becomes an even more difficult challenge. And I think you've probably seen around the homeschooling debate, the unavailability of broadband in a number of areas, meaning that a lot of pupils can't do their lessons, just highlights this as a structural problem within our economy. And let's remember that a lot of new banking services use the medium of Wi-Fi and broadband to deliver services. So this is an obstacle. Now, this has given rise to a strong movement to see the returns of what people say banks used to be, community banks, where services are provided and decisions made locally. The Community Bank Savings Bank Association supports the creation of a network of regional community banks, in fact 19 in all, across the UK, rooted in and dedicated to identifiable regions. There's one currently being looked at in Wales, for example, but several others have progressed significantly in the last 2 years. One or two have even got as far as their regulatory business plan submitted to the PRA and the FCA. So my contention is that this is a coming trend with local banks based on the one member, one vote mutual model, and will build on the brand of a particular region, and will argue with some justification that local deposits will be more efficiently and more certainly recycled into local assets, and that those positive economic multipliers will accrue to the local community. So I'll leave it there, as I say, those three provocations, and leave it to members of the audience if they want to pursue any of those with further questions. Thank you, David.
Okay, well, thank you very much, David and Gareth. That was a very good intro to the debate. We've now got 35 minutes where we can talk about some issues. I think the first question that I'd like to start with is, we have seen an improvement in the reputation of banks, as Declan was saying, but it does seem to be quite slow for banks to be improving their reputations. And I think it's fair to say that across all of the sectors that we researched, banks still come pretty much last in terms of people's trust and the general reputation that they got, which seems quite a strange result 10 years after the banking crisis, during which banks have been trying quite hard to restore their reputations. Now, is this back to the sort of cynicism that Brian showed when we first asked him about putting bank brands into a table, that, you know, fundamentally bankers are not really interested in brands? I mean, is there a persistent, lack of really caring? I mean, why isn't it happening faster? And maybe we could start with David, and then Gareth, and Joy can finish off, maybe.
I think 2 or 3 things, and I'll refer back to a conversation I had with the wonderful Ross McEwen, and this was to do with bankers' pay. It was when we were talking about whether he should take his bonus by every metric he'd earned it, and I said, you can't, because we're fundamentally still a state-owned bank, we haven't made a profit. And by the way, if you went outside and told people what you earned, even though you're the lowest paid CEO of the big banks, they'd think you were massively overpaid. So one, I think pay is an issue, and banks have taken out more than they put in most people's memories. Second massive issue is this as a sector, I think it's the worst at explaining what it does. Only when you work in a bank do you understand how absolutely fundamental it is to society and to how things work, because banks have never explained that properly. They haven't given a good account of themselves. And if you add those 2 things together, I think, trust rebuilds slowly. Because again, to go back to, what I was talking about, watching what NatWest have done, their reputation should have gone through the roof, should be incredibly positive, because all the actions they're taking are great. It hasn't, because, the trust is still low, lingers from the past.
Gareth, what do you think?
Yeah, I very much like David's point about banks have not been very good at telling people, what they do. I mean, I probably think more as a customer now than as a sort of bank executive and manager, and actually in many ways it's quite interesting. I look at it this way, that in many ways banking has got to a stage now you cannot live without it. It is a utility, and actually how do how do you make a brand of a utility? If you were living in a village or town that only had one bank left, and you didn't bank with it, what would stop you going to bank with it? You'd think you'd get exactly the same service. And I think that is what I define as utility. So differentiation through utility functions, I think, is quite hard in terms of brand building. I think where banks really do, like any product or service, start to resonate with customers is when it comes down to things that matter, life decisions, that mortgage. Imagine a company during this COVID crisis that did get the financing it needed to weather COVID from its bank versus the one that didn't. And then each was then asked to go and fill in a form, a survey about what it felt about that bank. You can imagine what the result would be. And so I think it's probably about those big life decisions and how well they deal with those. And I think one last sort of thought and reflection, and this probably features more with the challenger banks, I think possibly, is that, technology may not always be service. Technology, is technology a feature or is it a benefit? And I think there's been a lot of focus on features. I just wonder whether it's really been thought through as a focus on benefit.
So, Joy, did you have anything to add to that comment on the slowness of change with reputation?
Yeah, I have to say, I totally agree with both David and Gareth and your original remarks, David, because I just think that, people's memory is long and they do remember the last crisis. And I don't think there's been enough through this crisis. Obviously, a lot of banks are doing a lot of things, but the crisis really hasn't rolled out. It really depends on what the banks start to do when they have to start calling back in those loans and stopping those payment holidays and things like that. That's when people will really think whether or not their estimation of the banks has gone up or not. I do think it has still a lot to do with customer experience, because even though there's a lot of efforts and resources being put into the digital transformation, it's really still not quite enough in terms of creating that seamless customer experience, customer journey, the one view of the customer and all their different needs, financial needs as well. So that's another thing. I think some of the challenger banks are starting sort of to chip away at that a little bit, but then again, it comes back to trust. Even the challenger banks that are doing quite well, most people have more than one account, and they have maybe one at a challenger bank and one at an incumbent, but all their big sort of financial dealings are still sort of done with the incumbents. They haven't made that transformation because they still, at the end of the day, trust them. But I think they want more out of it as well. I think there's been a lot of talk now about this idea of embedded finance, so that that you have platform players and financial services just one of the, or banks are just one of the sort of constituents of delivering. So if you think about, everyone talks about the same thing, which is the mortgage, right? So go from the very beginning all the way through, and some banks are starting to do this, where they can help you at all those different, not just the financing, but all the different things that you have to do along your journey to buy a house. Like when you start talking about that, I think that's when it becomes more interesting, and people will, back to David Walden's point, people will really start to see the value of what banks do within society.
So I'd like to just slightly shift the emphasis of that question about reputation, actually, which is that here in the UK, we look at it with a UK perspective. And in the UK, I think it's fair to say we have a very concentrated banking industry, which I think has been largely a governmentally driven thing. They wanted us to have a concentrated industry, which has tended to dampen down competition. And even now with the challenger banks is dampening down competition. And also culturally, it seems to me that banks are a bit more cynical about their customers here. But in some parts of the world, like Canada and Singapore and various other places, I'm not sure that the level of reputational trust is as low as it is here. I think there are a wide spectrum of opinions about banks. Declan, maybe I could ask you to chip in here from the research. I mean, do we find that there are big differences in people's attitudes to the banks in different places? And if so, what lessons can we learn from it?
David, the reality is we don't actually find massive differences across countries. In nearly all of the countries surveyed, banks rank either last or second last in terms of overall reputation. But I think kind of just adding on to your first question as well, I think when people think about reputation for a bank, it's associated with their money and their livelihood, and a very different kind of reputational question than asking about the reputation of a telecom service provider, or a utility, or some kind of other sector where, if your phone stops working, yes, it's very much annoying, but if your bank loses all your money, that's got huge consequences for you. And I think that also plays a part in why reputation in the industry is so much lower than across other sectors.
It's funny, you burst my bubble. I thought that in Singapore they loved their banks. Gareth, you know Singapore well, don't they love banks over there?
I don't know, actually. I think love, actually, that's not a word I'd associate much with the banking sector during both my executive and non-executive life. So that's at least 40 years. So
okay,
no.
well. But I do think that DBS, for example, they have their mission is really around the joy of banking, right? Sorry about the pun, but the joy of banking. And it's like trying to, again, create that complete customer journey so that when you're accessing financial services, it's not a pain point, I think is really what they're trying to do.
Oh, sorry, Big Bud. Were you going to say something, David?
Yeah, I was going to say, I mean, in this world where everybody wants high tech and high touch, I remember having if I spoke to the component parts of my team, and to Gareth's point, these are not brands anybody's ever going to love. Trust and respect would be brilliant. Looking after your money, keeping it safe and secure. But, that notion that when you need to speak to a human being, you should be able to get a great one at the other end. So I would agree with Christian, who's talking about DBS. DBS is a bank that ticks all of those boxes, highly respected. Yeah. But banking brands are not going to be loved. They just need to be trusted, respected, because even the brand. Anyway, I'll stop.
Well, it's interesting because I think Spur likes to think that everybody loves them in Russia, and they're trying to make them love them even more by putting on all these extra services. So it'd be interesting to see what happens next. But the associated question with that is the development of fintech banks and challenger banks. People trumpeted that as a big, change, and it would shake up the whole thing. And I remember speaking to various bankers over the years, probably including you guys, actually, that they're not really going to make any difference. And probably, if anything, the only difference is that the big banks will just copy a few ideas and do it themselves. I mean, is the bank industry subject to enough challenge from these challenger banks? Should it be shaken up more?
Yeah, I think the bank industry has been challenged, and the regulators have on the whole favoured the challenges. So if you look at the capital ratios that banks have to carry, I mean, the slight problem is with interest rates up as they are, it's extremely difficult for everybody to make money and get scale. And some of these challenger banks that are loved are not strongly capitalized enough to do well. And actually, if you look at I was always a massive advocate of Revolut the moment it arrived, because that's a really fair customer proposition. They've struggled to expand beyond the original enthusiasm. They really have. And regulators have tried to help them. So I don't think it's the fault of the mainstream banks. And I also, by the way, I'm not advocating in the slightest that there should be lighter touch regulation. but I do think encouraging more competition fairly would be smart.
Do you think it's really going to happen, though? It's we're quite a lot of years into this whole so-called revolution, and most of the challenger or fintech banks have kind of tripped over themselves, haven't they? People like Metro and so on. I mean, they're almost undermining their own proposition and driving people back to the main banks, aren't they?
But I'll defer to Gareth on this, but I mean, it's not easy banking.
No.
Arrive in it.
Okay. So one of the other questions that has arisen is, the COVID crisis has driven everybody away from real cash and actually even real transactions. So a lot of the purpose of branch banking has kind of evaporated. And at the same time, from a business point of view, local branches don't have proper managers that can make decisions, which is really what Gareth was talking about with community business banking. So they're kind of making branches irrelevant. Are we going to have any branches going forward? I mean, will it all be done electronically?
Can I jump in?
Yeah.
Unless Gareth wants to. But I was going to say, I think in many ways that the incumbent banks are missing a trick, and some of them aren't, because some of them are actually expanding their branch network, like Bank of America, JP Morgan in the States, but they're actually transforming their branches into something else. So they're not transactional, but they're more, they can do video calls with the experts and get help right then and there, that kind of thing, right? So it's a higher value add. And I think, and I've argued this for a long time, I'm not sure if anyone's paid any attention to me over the years, but I do think that when you start to like cut swathe of your branch network, that also signals to people, for me, it reduces the sort of your positioning amongst the challenger banks, which are all digital, except Metro, but most of the challenger banks are just digital, so they're just online and stuff. And you have these premium high street situations, positioning and stuff. And I think about it even in my area, when, a bank decides to pull its branch and it is no longer present, then it also is not present in your mind. So you've lost that battle for people's sort of mind and ideas and stuff like that. And if I just think they're missing a bit of a trick here, and I think it will hurt their reputation going forward.
Yeah, and
So,
I think,
sorry, big one.
well, if I could just add to that as an anecdote, Starling Bank, arguably the most successful challenger bank in the UK, and definitely the most profitable, they've gone the other way and partnered up with the post office as to create a branch network rather than staying online. So they obviously see value in a branch network, and among the rankings, some of the strongest banking brands are the likes of the Post Office Savings Bank in China, purely because they're so accessible because of their large branch network.
Yeah,
sorry, big one, carry on.
I think let's add in a couple of COVID comments here. I mean, what was notable for all of us, I'm sure, back in lockdown 1 was the return of kindness and community spirit and people being more interested in each other. And I think that's continued. I mean, it does make it odd, therefore, that banks, once the pillar of local communities, have pulled the pillars out. And, all banks, so I'm not speaking about any particular bank, let me be very careful here, when they close branches, will all say, when was the last time you went in a branch and it's all gone digital? But what they don't talk about is community presence, how supporting the communities that you have people that live in, work in them, who want their branches and want to support local businesses. And actually, I think there's a big opportunity because the return of community is going to stick. That is a real, when we return to whatever the new normal looks like, I hope people will remain kinder, more thoughtful and more focused on their community. That's a great opportunity for a thoughtful bank.
Yeah, sorry, Dave.
No.
That was really the main point behind my provocation, is that I think there is something with localism, regionalism, and I think it's pre-COVID, as I said. I think with the loss of branches, there is, if you live in a market town which has its own identity, many of us will know one or two, may have grown up in one or two, but they have an economic life and they have a social life, and actually entities, institutions, banks that implant there and conduct business fairly, transparently, and in the ways that people want. And many people actually do want physical, face-to-face banking, particularly for some of those important life decisions. And I think actually, in terms of certainly on the business side, the ability, when we're going to be now the challenge of regenerating the high street by much more by different types of businesses coming to implant themselves in town centres, that is going to need finance. That's going to need understanding. That's going to need an understanding of the local economy and how it connects. And I think that opportunity is absolutely enormous. And that's where I think community banks will play their part. And actually, to garner deposits, one of the things it has to do is to provide a retail proposition, to us as individuals, that utility that we need to live our banking life. It has to be every bit as good as you can get. You can get those, and this is the difference between now and say maybe 10 years ago, certainly 20 years ago, is that those packages can be bought off the shelf reliably, relatively low cost, and perfectly capable of proper regulation. And so you can be up and running really quite quickly. And that's debit card, current account, savings account, all the payment interfaces that you need. It's there. And once people have got those, I think they're going to think, what else does this bank offer me? Actually, it's putting something back into community, and actually it's my community. I'll go with it. I think that is thematically the direction it's going.
Well, it's very interesting that if I think about brand finance, we've been going 25 years. And I remember when we first started up, we were tiny. I used to go along to our branch manager, and he was actually quite an experienced guy, and he gave me some advice, and he was actually pretty good. But gradually over the years, I won't be too rude about Barclays because I generally quite like them, but I would say the management structure has sort of been hollowed out. You don't really get branch managers that understand your business and will give you advice, which sort of creates a yawning gap. I would never dream of going to the bank manager to ask his advice about my business, whereas with a proper traditional bank you might. Now the interesting thing is, I'm thinking about competition and specifically in the UK context, but I suppose it applies to other markets too. You've got a bank like Handelsbanken who have come into the UK, and they pride themselves on having more informed managers who help people in many ways. And I noticed the other day that Chase Bank have now decided to come into the UK, which really quite surprised me. And maybe are they going to have a different model that's more intelligent, that gives more advice? I mean, how is that working? And could other foreign banks get in here? Could Chinese banks start providing services here? Joy, do you want to kick off with that one?
Well, I just think, yes, I think it's possible. So obviously JP Morgan is following Goldman Sachs as well in terms of offering a retail offering in the UK. And Goldman did it a little while ago, and obviously has done quite well out of it. So I think when you start to open up the market, then yes. And there's a lot of challenger banks that are trying to serve that SME space. So even Starling, which started as a retail operation, has now expanded and is looking to serve SMEs. And to be honest, they're the most numerous and the most underserved of the sections, right? So you have a lot of times you have very good retail offering, and you have really good corporate offering. But the thing is that the numbers involved in that is just huge. So if you could crack being able to serve as an incumbent, if you could crack being able to serve, the SME sector, then you can, then I think again, your brand value would actually go up quite a bit, because you would be actually providing services to a huge swathe. And then also, again, having that one view of the customer, because most retail customers are also, maybe they like yourself, have their own business and running their own business, starting their own business up and things like that. And so then you could follow the customer all the way through their journey. So I think, I just think it's really interesting. Obviously, we're in a very different competitive environment at the moment than we were 10 or so years ago. And I think it's opening up, sort of new business models and things, and technology is enabling that. And I think things will change quite dramatically, and maybe in a shorter period of time than a whole decade.
So does everyone else think that technology really is going to accelerate the shake-up of the banking industry? I think one of the features of the COVID crisis is that you look at it in the retail clothing market, the the crisis has basically killed off a lot of those slightly old-fashioned retail type people that weren't doing things properly on the internet, and the new guys have exploded. I mean, is there going to be a sudden acceleration of technology killing off old bank brands and the new guys coming up? David, what do you think?
I don't think so. I mean, I think old bank brands have learnt fast and do very well in the technology space. They have a slightly different issue, which is dragging the technology from the past into the present. And it's still the case that as you try and address your bank as though it's a singular entity, you'll run into people who go, no, you don't understand. I'm in a call center in, fill in X, and they think they're not part of the same delivery system. And that's fundamentally a tech problem. But I don't think so, because I think they're doing all they can to accelerate with tech, and also they have a scale and a resilience. And this is not a financial crisis we have been through, it's a pandemic. And actually what it proves is the incredible resilience and how well banks have recovered and got themselves into the right shape. I mean, to slightly go sideways, there's a different issue, because if you look at the stock price of the banks, you can see that the market still expects them to deliver the same old profit as they've always done. And this is something I do not understand. And actually, watching what's going on in the market in a broader sense, look at what Reddit has caused with GameStop and now with silver. People are beginning to understand different ways of making money. And I think that's a slightly different challenge to the banking sector. But there are all sorts of interesting things. But the resilience of big banks, we should applaud, actually, because I think they've learned and shifted pretty well.
Gareth, have you got a view?
Yeah, it's an interesting one. I think it would be quite good to read the essay written by someone far smarter than me on whether technology, we've got into a phase of, the law of diminishing returns, in the sense that, what thing that do I need as a consumer of financial services do I not have delivered adequately through technology? And that's what I meant about technology as a feature versus technology as a benefit. When the technological add-on creates a benefit, then I'm a buyer. I'll be much more attracted. If it's a feature, then I could be one way or another on it. But I mean, it's interesting. I think I can only speak for the bank, the two banks, main banks, high street banks that remain nameless, that I've dealt with over my life, and actually their mobile and internet offerings, which is where you tend to see the technology deployed, are I'd say not just more than adequate. They're absolutely excellent, and they've made life a whole lot easier. And I'm just thinking, what else could a challenger do, or they do, that would make it, maybe I just can't conceive of it, that would make it so much better that I'd pay more or become more loyal or switch. And I don't see it. I still come down to the fact that a banking relationship, like any kind of relationship, hinges on key moments in the way you live your life. And it's about those life decisions and how did that counterparty, that relationship entity, that entity I want to have a relationship with, how did it respond? And those are where you win or lose, clients and loyalty points,
So from the drift of the conversation that we've been having for the last 30 minutes or so is that a lot of this is down to fulfilling the customer better, and the customer experience journey and the whole suite of products and so on and so on, which I suppose in a way is what you would expect. You would expect banks to be better at delivering all this stuff. But I think most people do have a cynical view that banks, for example, will give the worst deal to their existing customers, because they make a bit more money out of screwing the people that are already there. They don't offer them what they should want. How is that going to get washed out? Is that never going to get washed out?
If Ross McEwen were on this call, his blood would be boiling, because he is the man that took all of that away. And nobody followed. The notion was, we will do this and the rest of the industry will follow, and the regulators will support us. Nobody did. So, you know, the fights, the bankers wanted to return zero, you know, the balance transfer and things like that. We always resisted that on the basis we were trying to do the right thing, but the sector didn't follow. So it's not, people have tried, but it doesn't work. So I do think some of these acts have been tried and it's difficult to kind of force ahead. But can I just pick up, because Christian, who's being so active on the chat here, we need to kind of follow some of the things. I think he's absolutely right about, there are technologies, blockchain, for instance, which big banks have enough money to actually look at what's the utility of blockchain, how can we change things, how can we create more safe environments, and actually they're big enough to do that. So maybe it's the scale that will help make the changes, because we haven't talked at all about the importance of data and the importance of looking after your data. Banks are very well placed to look after not only your money, but your data, and to keep that safe and secure for you as well. And I think people are getting increasingly concerned about that. So, you know, as we approach, I'm kind of optimistic about the future of banks, as long as they're nimble enough. That is not a word that most people would associate with banking. So I think
well, it's funny. A couple of years ago, at one of these brand finance banking forums, we had Peter Estlin, who was from Barclays, and I don't know whether you were there, but it was quite funny. He was sort of giving the view about how the banks like Barclays would gradually adapt and meet the demands. We had another chap called Phil Motchen, who now runs Coiny, who was basically going, all the banks are doomed. They're irrelevant. They're like dinosaurs. They'll be completely gone. Everything will be what do you call it?
Disintermediated.
Disintermediated, yeah. And that basically banks are irrelevant. And I remember Peter Estlin was more or less laughing. You know, he sort of like, he didn't like to be rude, but, you know, he thought, no way, that's never going to happen. Banks are going to be there. But one sort of slightly quirky question to ask is that there's been a lot of speculation that the government is going to start going for negative interest rates. And I just want to know, how do you think customers will react when they start getting charged for putting their money in banks?
Oh, well, all I'd say, I mean, I'm not an economist on this, and I do remember, and I'll tell you the date. It was in, I think it was in 1979. I once made a loan at the bank I worked for at the time to a company where the rate, you know, cost of funds rate was negative, and the margin was a positive, and the sum together it made it. And I have to say, so that was about 35 years ago. And or 40 years ago, and I have to say I still don't understand it now to this day. So this was in Swiss francs at the time, and I must say I must just profess public ignorance on this about what the effect of negative interest rates would be in an economy like ours. And I just wonder if there's a body of research anywhere in a sort of comparable economy where those conditions have prevailed. I'm told the theory is
that if you get charged for putting it in the bank, you'll just go out and spend it. So we'll get an economic boom. Which
well, we know
is
the
what
purpose of it, but
but you know, I can't believe it'll really happen.
I mean, in fact, I confess I've always been, I think I'm going to go with bemused about how this works. But I know the Nordic banks have had some success, and it probably is worth looking at the Nordic case studies, because of course ultimately, you know, the customer benefits from lower mortgages because it all goes round. But I'll stop there and just remind you I'm bemused by this.
So I'm just going to finish with one quick question to Declan, because we had a question from someone in the audience saying, could you explain the connection between the brand strength index and brand value that we calculate? And when you've answered that, we'll ask Joy to say the last word.
Sure. Yes, so I think that came from Daniela, and it's a question we get quite often. It can be quite confusing. I think the way I like to think about it is when referring to brand strength, it's the way that it's perceived in the hearts and minds of all of its stakeholders. And largely that's independent of scale or size. We then use the brand strength as an input into the brand value, which of course is influenced by scale and size. And I think a good example is changing industries. If you look at the car industry or the auto industry, you know, Ferrari is inherently a very strong brand. Everyone wants to own a Ferrari, but it's a far smaller business and less valuable brand than the likes of Toyota, who is so prominent throughout the world. So, for much smaller brands, I think brand strength is a much more relevant metric. However, if you're thinking about, purchasing a brand, then you have to look at brand value.
Right. So I'll finish off by saying thanks to Gareth, David, Declan, and Joy for joining the panel. I've enjoyed the discussion. I'm sure we'll carry on having these discussions in the future. And Joy, would you like to say the last word?
I can. I guess what I find really interesting, especially when you start to look at the, over the past 15 years and how the brand value has changed, but also the brands, as we started with the European and American brands, obviously moving through up to the Chinese brands. I guess my big question is how long the Chinese brands can stay at the top, and can they, because even now their growth, so, let's say over the past 5 years, their growth was in double digits. And now the last couple of years, it's only been about 1%. And obviously they're still growing versus, let's say, the UK and the US. But at the same time, can they continue that meteoric growth in the future? And then when we come back in another 15 years, who is going to be on top? It'll be interesting to see.
It will. So anyway, thank you everyone for attending. I hope you've enjoyed this session. If you've got any questions, just send us an email to Brand Finance, or if it's to do banking, ask or the banker, ask Joy. And thank you very much. And I'll hand over to Zoe to give you the last word.
Yes, lovely. Thank you so much, David. And thank you so much to all our panelists and speakers for joining us today, and for all our audience as well for a very interactive Q&A session. So thanks so much for all your interesting questions that certainly did make a very, very interesting discussion. So thank you all so much. Please, obviously, do access the recording after the event today, which will be available on our YouTube channel from tomorrow morning, I believe. And I'd again like to encourage you all to complete the survey that will pop up at the end of this presentation. Thanks again so much for joining us online for the Brand Finance Banking Forum 2021, and really hope to see you at future events soon. For further information, email events@brandfinance.com, or for inquiries @brandfinance.com. Thanks so much once again, and look forward to reconnecting with you all soon. Thank you.
Thanks very much.
Thanks.
Thanks.
Bye.